This is part 2 of why I stopped trading prop firms. If you haven't watched part 1, click the link in the right-hand description. The market, SPX, has only risen above 2% 78 times out of the last 5 years. In contrast, in the broader stock market, there were at least 66,000 instances over the last 5 years where stocks were up 10%. And then even 1,826 instances where a stock was up 100%.
If there's people like Ed Berry that can double their account on these shorter time frames, like that doesn't happen on the hedge fund space. What hedge fund is doubling their account in a year?
Man, this is incredible.
If you're even beating the market, most hedge funds, they're not even beating market returns. If you're a good trillium trader, that's laughable. That's laughable. You're not even blinking at market returns, right? If back in my prime, you gave me a $100,000 account. That account is making money every single year, and that account's making a lot of money every single year.
This video sparked a lot of controversy. We had a polarizing views in the comments, and there are a few review videos. And I wanted to clarify some of the points because I get it. Human beings are suffering now from the tribal trap. Online, you can go down the rabbit hole and find sources that validate your bias. And when you hear things that challenge your opinion, your views, we tend to ignore those things. But me, I have a certain intellectual curiosity. And what I really want to do with this channel, number one, I like to bring the professional knowledge to the retail trader. Now, in sports, Ronaldo, Messi, Kobe, Jordan, these greats, you can see their performances live. There's a scoreboard. You can see their stats. But the Kobe and Jordan level talented traders, you can't see their performance. Now that poses a problem because the retail trader is then left with the influencer, the YouTuber, or those traders that decide to come out and reveal themselves, right? So we have a dilemma. So I've spent majority of my trading career going after professional knowledge, trying to get behind the proprietary desk, reading as much as I can, going to the trader meetups and conferences that pros put on so that I could find the Jordans, the Kobes, and emulate them. What I would like to get out of this discussion, if you disagree or agree, I like to bring an argument to the space that is unique. That's one. Number two, the reason I like to bring this argument is because I think that it'll make the retail trading space better. It would improve the space. That's all I'm trying to do. On my way up, some people mentioned in the comments, hey, man, you got payouts from evals. You got to where you are from eval firms. My response to that is that let's say we are in a business and we're climbing up the mountain and we get to a certain point and we meet other people that have the same business and they're actually doing much better than you. Actually, they're doing much better than some of the stars in your hemisphere. So in the eval space, and we celebrate our stars. And we have people that have 1.5 million payouts, 2 million in payouts, 3 million payouts. But as I started to mingle with the pros or those retail traders that were stars in their own right, some people had 14 million, 15 million, $20 million, $80 million verified in profits as retail traders. So I said, okay, why? So I'm traveling the path and I'm looking back and I say, you know what? If I were to start over, I would have taken a different path because I believe that the path is better than the one I took. My main point in that video, though, most people skipped over. I understand. And I'll repeat it here, but I want to touch on a few other points that I believe people just can't get over, which I understand. It's all good. My number one reason for switching is because I wanted to switch to the stock market. Is that the stock market is less efficient. There are more opportunities. There are wider ranges, trackable influences for price movements. Let me comment on a few things that were that people thought were silly. And I agree with them before I moved into the pro space. One argument that people just really didn't like was people say a day trader cannot make 100% year over year. And the argument is, and people point to hedge fund returns to support their argument. I have to tell you, I agreed with this in the past. So yeah, of course, hedge funds maybe return 10, 12% year over year. So it's silly for us to think that a day trader or a retail trader can consistently outperform that. But I was wrong. As I mentioned, now proprietary day trading firms like S&B Capital, Trillium, and others, they are private, so they don't publish their returns. So we have to look at the traders that come out, give us information, or we look at retail trader stars that are third-party verified. That's how we can find out if this is true. So I get it. If you believe that a day trader is capped at the returns of a hedge fund, then my second claim that I made in the video of a trader taking 60K to $1 million, that claim is even more bizarre. Why? Because you said you think that a trader is capped by hedge fund returns. Okay. So now give me the opportunity to bring a professional trader, Lance Brightstein, one of the top traders of our generation. He is a Kobe Jordan level talented trader, individual day trader. He's been verified by 3 different sources: Trillium, his prop firm, Kinfo, and another source. Let's listen to what he says about the returns of day traders.
The returns of most day traders, like, I mean, there's people out there, like, there's this guy I'm friends with, Ed Barry. He can take a 15K account and he can return 100% of that, no problem. No sweat off his back. He's profitable every single day, pretty much. And I've known traders that are profitable, even at Trillium. There's people that are profitable nearly every single day. Do you know a single hedge fund that's profitable nearly every day? Yeah. There's trading firms out there like HFTs that are doing that, but they're on the micro time frame, right? Micro for thousands, millions of transactions a day. Now, if there's people like Ed Barry that can double their account on these shorter time frames, like, that doesn't happen on the hedge fund space. What hedge fund is doubling their account in a year? And this is incredible. If you're even beating the market, most hedge funds, like 90% of hedge funds, that's kind of a made up stat. I don't know the real number. To be real, like, they're not even beating market returns. Like, the average Trillium trader, if you're a good Trillium trader, that's laughable. That's laughable. You're not even blinking at market returns, right? If back in my prime, you gave me $100,000 account, that account is making money every single year, and that account's making a lot of money every single year.
Number 2, I'll show you some of the retail traders: Tim Grittani, Jack Kellogg, Kyle Williams, Christian Koulamagi. I'll show you some of these traders that are third-party verified that take in small amounts: 15K to 14 million, 15K to 8 million. I think Koulamagi said he started with about 5K to over 80 million. And these are swing traders, scalpers, intraday traders, a mix of the gambit, a total mix. So I'll show you some of those, and then we'll get into the data, right? And in the data, you'll see when it comes to something like SPX or the indices, when it comes to that, looking at that versus individual stocks, the percent gains over the last 5 years, I pulled that data, ran a Python program, are not even close. All right, so let's jump into it. Okay, so this is Kinfo, a website. It's a third-party verification website and a trading journal. This website is a source that's common in the stock community to have your statements verified. They actually, I want to point out 3 people here that started off small, right? So we'll start at the top of the list. Jack Kellogg is known in the trading space. He started with about $1,500 and eventually grew his account to 14 million. Now, if you read the Market Wizards series by Jack Swagger mentions individuals like this, but he refers to people that may have their prime was 20, 30, 40, 50 years ago. So what I'm looking at here, these are people that are young, and if you look through their trades, if you look at their equity curve, these are talented, skilled traders that started off small, and due to the amount of trades, which I'll get into next, I'll show the comparison. I'll compare the futures forex and the stock equities markets and show you how many opportunities exist in each market, so that you can see that these guys, us stock traders, equities traders, we could do something like this because of the amount of opportunities. And 2025, I'll be sharing my journey here. So Jack Kellogg, if you look at, I won't go through this in detail, but if you look at his profits, they're rather, they're smaller in the beginning. If you look at his equity curve, massive amount. It's a slow start like many people would have. And then it starts to ramp up. He starts to size up. 2020 and 2021 were amazing years for a lot of traders, right? So Jack Kellogg is one person. Okay. Another person is Kyle Williams. He took about 4K to now 6 million. Okay. This is incredible returns. Then you have someone like EDU Trades, who I know, he is from Venezuela, and he started off with $1,500. Now he's at about 1.7 million. So this is Eduardo, scalper, 1.7 million, career 72% win rate. Okay, average gain is $100. Right, so look at his gains for this. Okay, let's say year to date, he's made 500K almost. Okay, average gain $81. He's scalping. Okay, so it's the frequency, 74% win rate this month, 1 year, Okay. This month, average gain, $100. Okay. 73% win rate, 47K in profits. Okay. And if you look at his latest trades on the 23rd. So like Lance said, okay, December, this guy makes 47K. He's generating profits almost every single day. He has losses, but one day here, 8K in one day. We're going to see a lot of different tickers that he's trading. Relatively, when I say a lot, relative to Forex and the future space, he may trade 5, 6, 7, 8 different tickers in one day. And that's how he's generating this. It's not a matter of percentage. It's a matter of opportunity. Let's look at the data. I designed a program to pull the percentage gains for SPX 500 or ES. SPX has only risen above 2% 78 times out of the last 5 years. In contrast, in the broader stock market, okay, there were at least 66,000 instances over the last 5 years where stocks were up 10%. And then even 1,826 times instances where a stock was up 100%. So what I want to point out is over the past 5 years, okay, so we're going from 2%, only 78 instances, and stocks being up 600%, 70 times. Of course, the differences in the market, SPX, steady growth, people park their money there for steady growth, and it's consistent. But in the stock market, you have larger, broader ranges. When I spoke about the tight ranges, that may cause traders to get chopped out. What I'm proposing is that during those choppy periods, you could be trading something else that has directional skew. Here, if the majority of time we are moving 0.5% on indices over the past 5 years, okay? Less than 0.5%, that's a small range. So while that small range is occurring, you have here where there's stocks at least up 10 times, 50%, okay? Almost 10 times the amount, right, for a given year. So that means that when indices are ranging, or maybe a currency pair is ranging, you leave that alone, because I think we can all agree that the range has lower EV than the trend, than something that's trending that has directional skew. So what I'm arguing, I personally, when I got to a certain level, I met traders and I started to see a different pathway to where I wanted to go. Now I'm looking back at traders and I'm saying, hey, you're in the Forex space, you're in the future space. You may not know that there are some other options out there for you, but there are some other options that can help you achieve your goal. Okay. So the data speaks for itself. Now, I saw people say, well, stocks range. Yes, an individual stock may be ranging, but while that stock is ranging, we can move over to something that's not. So what is a 0.5% move? What does that look like? Okay, so looking at it's 692 times, right? Okay, what does that look like? All right, so what's a 0.5% move look like? So this is, let's say from here to here, that's less than 0.5%, okay? From here to here is less than, 0.5% right there, right? This would be one of the moves that reach 1%, right? These are the days where I personally made more money on these days, right? When you had price moving up directionally, and I could take more like these days right here, right? When they move more than 1%, these are the days. Now, what does a 2% move look like? 2% move looks like this here, right? Massive candle. So these are the days here, maybe here. These are the kinds of days where I personally got chopped, and I believe that others get chopped in with these types of moves. And if these are the majority, then why not switch to a style where you can trade, you can find those larger moves, right? So we just take 50%, the 50% moves. And I go here to my spreadsheet and I filter, I say, okay, now this is a part of my edge. You say, hey, let me get the spreadsheet. Those that are with me in my group, they'll have it, but this is just a part of, right, what gives me edge to be able to do something like this. I'm just gonna pick one here. All right, so we take a look at drug, right? So drug, we're ballpark around, my dates may be just a little bit slightly off, but just look at this move from, the open to the close, up over 1,000%, right? And this is a directional move. That's what I mean. I don't want to trade, this, me personally, I believe that the intraday, the moves that have directional skew have a higher EV, higher expected value, right? So that's what I'm trying to find. So instead of me looking at one ticker and trading it when it's ranging, I'm just constantly every day finding those tickers that are going to be explosive. All right, so let's use a basketball analogy just to drive my point home. So imagine two basketball players. They shoot 60% from the line. Okay, and I'm using trading numbers here. All right, they shoot 60% from the 3-point line. Okay, they take player A takes 50 shots per season. Player B takes 250 shots. Now, player A with the 60% win rate, okay, they make 90 points total. Okay, this is all rough numbers. All right, and then the player that takes 150 shots, the player that takes 250 shots, 450 total. This is 5 times the amount of points made. Same win rate, okay? Let's take a trader that takes 50 trades per year, 60% win rate, 1 to 2 R&R, okay? This person has a 5K account and they're risking about 2% per trade. So over the year, with that 5K, they can generate 9K if they have a 60% win rate, 1 to 2 R&R, all right, at 2% risk. But the trader that takes 250 trades, regardless of what market it is, that person is going to make 25K. Same skill level, as long as they can uphold the same win rate in R&R. So my argument here is, while a person may want to increase their output with a smaller account, if they were to do so, then the best market would be potentially the equities market, where you have larger percent gains that are happening more frequently. That's my argument here, right? So the trader that is, going the prop route, if that's best for them, that's best for them. But I'm just presenting another side where if you can save up a little bit of money and you use your skill to learn the equity side, you can have control over your trading business. You can build up that capital over time without the rules, and you have the skill to take advantage of a market that has a dramatically higher magnitude of opportunities and ranges. Now, we can get into the argument of whether or not you want to take 250 trades and all of that. We can point at swing traders in the equity space, like Christian Koulimagi. Because there's more swing opportunities that he can just put on, right? He can outperform potentially a trader that is in the future space, potentially, if they have the same amount of capital, because he has more swing opportunities. And the ranges, the R&R, the ranges of movement are much greater. Okay, so as I close out, so we've talked about growing an account by 100%. The difference between hedge funds and day traders. We talked about, and I've shown through Kinfo, traders that have taken, 4K, 1,500 to $1 million. And I showed you why this is possible. Now, there are a few other points here that we could discuss. The buying power versus drawdown argument, I won't touch that one. I don't think it's necessary here. But one that I think is necessary and very important, is fundamental to my argument, okay? Some traders say the market doesn't matter. All it matters, the futures market isn't better than the equities market, or our currencies aren't better. No one is ever going to agree 100% about what. Let me just elaborate a little bit more on my perspective here. This is where the concept of mispricing or inefficiency is important here. If you believe that all markets are the same and it's all about price action, I understand. This is where I like to challenge your idea, okay? Let's use computer sales as an example, okay? So let's say that we have a MacBook Pro and MacBooks are trading at $800. All right, so we see fluctuations. Every day we see fluctuations. An event happens, for some reason, some news comes out, and now the price of the MacBook should rise up to $1,500. The price of the MacBook, an event occurs, maybe Apple puts out a statement, something happens. Those that know auction market theory, those that understand price discovery, mispricing, let's say an event comes out, and now instead of having that $800 price, the MacBook is going to go up to $1,600. It's going to go up 100%. This right here, when the event comes out, from here to here, those that understand the cues, maybe so the news comes out, there's 5 times the normal volume traded. Okay. Maybe like in the last 14 days, it's 5 times the volume traded. So that's a sign as well that more people are rushing to buy MacBooks. Why? Because the price is going to go up. And they want to buy at the lowest price possible. And then eventually some of these people will sell as the price continues to squeeze higher and higher. So this is price discovery. This may even go up to 2K. Okay. So fundamentally, the concept of price mispricing, okay, and inefficiencies, it lies here, where when the MacBook was trading like this, in my opinion, it's harder. This is a lot of this is noise. There's things happening. There's buying and selling happening in the market. You know, people trading, you know, just for small amounts of gain here. But when you have something that drives the price higher significantly, there's a mispricing that occurs. And this is where the inefficiency is. And we can track this because there's an event or there's 5 times the relative volume. So you don't always need a catalyst. Sometimes you just look at the volume and you see there's 5, 10, 20, 30, 50 times the amount of volume when the stock hits the scanner, right? So let's say you open up your newspaper and now Macs are trading at 1K. You're like, okay, we got like 20% gain. Then you go and check and you see that the relative volume is 20, 30 times the amount of people are buying and selling Macs now. Then you go and look for news and you say, there's a catalyst for this move. And here you have a beautiful, in my opinion, a beautiful system that is structural. This is how the stock market works, and it goes the opposite way. News, interest, price discovery. This is the same thing with auction market theory. We're in balance, then there's something happens, we're out of balance, there's going to be price discovery, and then we're in balance again. Okay, so this is happening in the stock market, as I mentioned, day after day. I think we had a number of 10% plus out of the last 5 years. Over 60,000 stocks were up 10%. Okay, so this is the foundation of my argument here, that yes, while you may say, no, I can sit here and read the candles and each candle has a meaning, and I can just, scalp the range here. Yes, you can do that. But this here, in my opinion, is easier. That's what I'd like to communicate. Okay, that's the first thing. All right. Now, there's a huge mention of, okay, well, the eval company offers me funding. Okay, so this is where I want to bring up the conversation of opportunity costs. Okay, this is and everybody, there's no right answer in my opinion. There's an answer that is right for me, and everybody has to think about what's right for them. So the opportunity cost here, you have time that's spent learning. Okay, some people are spending their time learning how to beat the system. So some people have mastered the payout to challenge ratio. And there's an edge here. There is an edge. Okay. But if you spend your time doing that, the time that you spend doing that, you are trading, okay, for time that you could be learning something else. And if you were to say, yeah, you know what, the stock market offers more inefficiencies, more mispricings that are and more edge, that's time that could be better spent, right? So another person may say, well, capital. Okay. So yes, you may in the short term make more money. You may make more money in the short term if you go the eval route. You may, because there's another aspect of this, and in my opinion, it's the psychological aspect and the rules. Okay. If you are to agree to that, if you don't, no problem. But if you're trading something that is more efficient, then it could be more stressful to find an edge that is consistent. If you trade something that's dominated by more sophisticated players, like the indices, then while you're trying to chase the edge and trying to interpret what I would call market noise, And again, we're going to disagree because what I'm looking for is this, and this may be market noise in my opinion. There aren't clear reasons for mispricings. Okay. And the market is efficient here, it's balanced. But here's where the inefficiencies happen. Okay. So the choppy price action on indices at times, in my opinion, is market noise. 500 stocks on the SPX that are all just moving to their own accord. Okay, that's what I would call market noise. That's a technical term. So psychological issue of trying to master something that is efficient. And then on top of that, the rules, trailing drawdown, you have to trade a certain amount of time, et cetera, et cetera, et cetera, right? So while in the short term, the eval companies appear to be the best route for me, the longer term, in my opinion, I see the curve going like this. Okay, if I'm making some capital gains with eval, maybe I'm a little bit slower. If I'm starting off, I'm a little bit slower if I'm going the stock route, but eventually I go like this, like we saw some of those Kinfo dashboards, right? So that's just my 2 cents. Again, we're brothers and sisters in the trading space. I'm just bringing different perspectives so we won't fall into the tribal trap, right? Much love and respect to you all. If you want to see my $500 equities challenge, and I'm going to start here in January, watch this video.